Welcome to 2025. I have decided to come to you for the initial meeting with one of the investment firms from home. So welcome to my home. I know I've recorded before from this location, but I wanted to keep it comfortable. We are going to take under 20 minutes to have a conversation. And I will tell you why. This is the first meeting of the year. We're in mid-March here, and I've got Austin Fitch of Horizon Investments, who's been kind enough to join us many, many times. And he has a lot of fans out there, and I'm happy about that as it applies to Tranquilli Financial Advisor. But I have waited to record these videos, and we do have others that I'll start to record and send over the course of the next month or so. But the reason for waiting is there has been so much noise to start 2025. And I did not want Tranquilli Financial Advisor to be a part of that noise. There's, let's just say, shouting going on in all directions. And rather than shout, we would like to have a conversation that gives some context and some thought, some real preparation for the rest of 2025. So with that, Austin Fitch joins us. Austin is the head of consultancy. Sorry, I will get that out. And part of the investment team at Horizon Investments. He is a chartered financial analyst, and we are always thrilled to have him as part of our conversations. Austin, welcome back.
Absolutely. I appreciate you having me, Lou.
Of course. So let's jump right into the headlines, if you will. And you can see our disclosure is up there, and I won't read that any longer, but I will say that I appreciate Austin putting that up. So the headline this week, Donald Trump, and we're not getting into politics, we're touching on who is involved in the conversations. Donald Trump announces that a recession is certainly possible at the end of 2025. So first things first, to unpack that, there's really no prediction in there at all, because a recession maybe by the end of 2025. So you don't have a date, where you have a wide calendar view of this. There wasn't a will be, it was a could be. So I think, Austin, and something that I've read, and you know how much I read what you put out and others and everything else, that I thought was brilliant, is that really what we're witnessing is a fight between Donald Trump and the Federal Reserve. That's really what this is about. Donald Trump himself wants a lower interest rate. And again, no politics involved in this, just what the president wants a lower interest rate, and the Fed is not giving it to the Trump administration because they don't see a reason to. So if I could ask you to comment on, is this a fight between let's leave out the specific name, let's say the administration and the Federal Reserve, and why is the Federal Reserve not moving on interest rates at this moment?
Yeah, no, I think that's a great question. And I think there absolutely is a fight of sorts going on. I would tell you the current administration, to some extent, is picking fights with a couple of different, groups at this point, the Fed being one of them. As you mentioned, Lou, they absolutely would like to see lower interest rates. Obviously, that creates maybe an easier environment for businesses when it comes to financing. There's a number of different things that potentially benefit the economy as you think about lower interest rates. But to your point, the Fed's not really budging at this point. Part of the reason is the underlying strength of the economy right now is actually still pretty impressive. If you actually look at revenue growth, earnings growth, like we just finished earnings season a couple weeks ago to wrap up 2024. And while it may not seem this way, revenue growth, so top line growth of the economy was over 5% in the fourth quarter of 2024. Like that is still like probably a higher growth rate than you would normally expect from an economy that, is as big as ours. If you think back, like, yes, we had a slightly higher growth rate the third quarter of 2024, but outside of that, we hadn't seen it since we were coming out of COVID, when things were going kind of gangbusters after we had seen that really sharp dip there in 2020. So it had been a few years since we've been growing at the rate that we have. And you really have, again, you have a strong business environment, generally speaking. You actually have a very healthy consumer. a fully employed consumer. I mean, you're looking at unemployment rates in the 4% range. Long-term historical averages from an unemployment rate standpoint are closer to 6. So like you've got an economy that is chugging along, and to the Fed's point and why they're not considering, significant rate cuts from here is there's really not a need to as it stands today. And that's where exactly as you brought up, you've got an administration that says, well, if we need to sacrifice growth to potentially get that is something that can, we can implement some policy that potentially puts growth at risk. Now, hear me say this, like our base case view is that we don't have a recession in 2025 because we think the consumer and the business environment actually is really pretty strong, as I just mentioned. 2, we think some of the some of what has been said by the administration over the last 6, 8, 12 weeks, we think is more of a short-term play as opposed to like long-term policy. So I think we'll see that play out potentially as we head into the middle and back half of the year. But I think you're absolutely right. There is the kind of this push and pull between the administration and the Fed as it comes to, as you come to think about interest rates.
All right. Thank you for all of that. So I think a good way to finish this part of the conversation is that there needs to be a calming down of a reaction to, and I'm not being specific to investors really. Yeah. I'm not getting calls overreacting to any of this. Yeah. What I am getting calls about is, well, how do we handle this? Or what does this mean to our investments? And I give the same answer I've given it for years because it's an applicable answer. Politics is a constant agitation. These may just be louder politics than we're used to at times. So I think we can move on from that Fed administration fight and look at let's go to the stock market right now. Yep. Down if you're using the S&P, which we have agreed in the past we don't want to, but that's the one everybody sees on the news. So we'll deal with it. S&P 500 up until, and I have to give a market close so that compliance is happy, March 11th, 2025, down approximately 7% for the 2025 calendar year. Using that index, but maybe even going broader than that, what is the outlook from Horizon for the next 9 months of 2025?
We think, again, given some of that underlying strength that we talked about, we think the next 3 months could continue to be maybe a little choppy with some of the uncertainty that we talked about. But by the time we make it to the end of the year, really wouldn't be surprised if you actually see a positive market to finish 2025. I think, as you mentioned, the market is dealing with that uncertainty as it sits today. But the underlying fundamentals remain strong. I think what you've seen is so far this year is kind of a broadening out of the market. And what I mean by that is kind of this, like, if you look at areas of the marketplace that have maybe struggled the last few years, you're starting to see those turn the corner. And some of that is because on the margin, maybe they're more attractive or they're more certain. Specifically, let's talk about international stocks, for example. As you mentioned, the S&P 500 as of the end of day, March the 11th, down 7%. I would tell you European stocks over that same time period, year to date, up over 8%, like a 15 percentage point difference between kind of two developed, regions of the world economy, or the world market, I should say. So like you've seen that within the US, interestingly enough, like we talk about the S&P 500, if you actually take all 500 of those stocks and you just equal weight them, so everybody kind of gets the same, the same weighting, you actually are only down about 2 to 2.5%. So what you're seeing is kind of this unwind of some of the top tier names or the mega cap growth companies that have really led the market for the last couple years, and they've actually been kind of front and center as we've talked about some of the challenges in 2025. And I think that's an interesting dynamic to unpack and probably what plays out as we get into the rest of the year is this broadening out of leadership across the global markets, as opposed to, hey, these 7 names are going to continue to lead us higher. I think that's where we would expect 2025 to go. And once you get that certainty to start to filter back in, again, the broader market probably goes higher. but you have parts of it that actually could have a really strong year in 2025.
All right, and I'm going to ask you to touch on banks. I don't know about everybody else, but the offers of loans just won't stop coming in. The 0% credit offers just continue to come in. And to me, that means they have money to lend,
Yep.
and it's not being borrowed. So isn't that a critical part of keeping an economy moving, is how strong are your banks? How strong are the banks in the U.S.?
Yeah, the banks are actually in a really good spot. I think part of the challenge from a lending standpoint is when it comes to like a corporate finance perspective, or even a personal finance perspective, some of that uncertainty that we're living through is weighing on people from a mentality standpoint, right? Like, pick your corporation and pick their spending plan for 2025 and 2026, and the potential, hey, we need to go take out a loan to go tackle this project. You've seen that get pulled back just over the last 3 months because there's uncertainty around, okay, what is that? What does it mean from a tariff standpoint? What does it mean from a deregulation or a taxes standpoint? And a lot of that is unclear at this point, which has led to much of what you've seen and what you're alluding to, Lou, that you have banks that are really out there trying to win that business because, as you mentioned, like, they've got the money to lend and they're actually in a pretty good spot from a fundamental strength standpoint. So you look at kind of where they sit, it's actually, pretty healthy, all things considered, especially if you think about, the last time that we really headed into a, severe recession, 2008, right? Night and day different in terms of financial health of those institutions.
I would be delinquent in my duties if I did not ask about tariffs and the impact. Now, I'm gonna. This is one of those softball questions. Okay, I'll be Barbara Walters, and you be whatever politician you want to be.
There you go. Yep.
God bless her, and her work, which was great, but it's sometimes softballs. So the tariffs, as I've spoken to or met with. Some economists have said, look, for smaller economies, the tariffs will have some impact. Yeah. The U.S. is not a small economy. And for larger economies, they'll just simply tariff in reverse. So you're trading dollars. And at the end of the day, it's just a giant accounting exercise with a lot of headline risk around it. How inaccurate or accurate are those statements?
It's spot on. Tariffs make for really great headlines. They draw readership. They draw eyeballs. You could call it clickbait, whatever you want to call it. If you think about the actual impact of even some of the tariffs that have been talked about, where you're talking 25%, 50% tariffs, like the potential impact to the overall kind of GDP or growth of an economy is likely less than 1%, which in the grand scheme of things, again, if you're growing at 2.5% instead of 3.5%, is that a marginal negative? Yes. Does that mean that it's the end of the world for the U.S. economy or the global economy? Not by any stretch of the imagination, right? And what I would tell you is it would be a very different conversation if we were having this tariff discussion in 1975 versus 2025. Right. We live in an environment, we live in a world where economic growth is driven by a service-based economy. Right. In the U.S., it's almost 3/4 of our economic production comes from services. Right. So we just don't live in a world where tariffs on goods are going to have that big of an impact on economic growth and economic activity.
Well, and later on, when everyone watches this, I'll know how far they've gotten if they send me an email that says, I love Barbara Walters. Nice job, Lou. Okay, for setting up that softball question. All right. So with that, let's touch on one more thing. We said we'd keep it around 18 minutes or 20 minutes.
Yep.
And we're going to do it. The bond market. Where is Horizon on or have you changed your opinion since the end of 2024 when we last spoke? We were staying away from, call it the long end of bonds. Anything beyond really even 7 years, as I recall our conversation,
Yep.
were more or less a no-no. Where are you at on bonds right now?
Yeah, I mean, I will say what you've seen to start the year is actually like it would have been maybe beneficial to hold those long duration bonds, but we think as the rest of the year plays out, like the view or the position we had at the beginning of the year is absolutely where you want to be. And I think what you'll see play out for the rest of the year is some challenges in some of those longer duration bonds. I do think you are starting to get bonds that maybe act like bonds again. And what I mean by that, right, is you're not getting maybe negative or capital depreciation like we saw over the last couple of years in a rising interest rate environment. As we talked about earlier, I don't think we expect a falling interest rate environment, or at least a significant falling interest rate environment. We see an environment where, hey, it probably makes sense for, you're going to pick up the yield on whatever that bond may be, plus maybe a percentage point or two in capital appreciation. And that's where like there's not a ton of value to that long duration, bond. Long dated bond is only really in that scenario just going to give you more volatility. So we think
the risk is not
they
worth
can
the
play a
reward.
role, but like it doesn't need to be some massive, component, and it doesn't need to be taking on a lot of risk.
Okay, and I apologize for interrupting you, but the risk at the long end of bonds just doesn't seem, the reward is not waiting
Right
at the end kind of
Yep.
thing at this point.
You're absolutely right.
All right. Well, he is Austin Fitch, head of consultancy at Horizon Investments and also part of the investment management team. Austin, always a pleasure. Thank you so much. We'll do it again. You're obligated for around June or so. And you didn't say you'd do it, but I'm telling you, you're obligated around June.
Sign me up. We'll do it.
All right. Excellent. Thank you. Appreciate it.
Awesome. Thanks, guys.